2024, the year America has a full-blown financial crisis. The U.S. credit cycle has been distorted by the loosest monetary policy in the post-war era. A surge in long-term Treasury bond yields and a crisis in the commercial sector could lead to a hard economic landing next year. It's a cycle that Hyman Minsky says is influenced by easy monetary policies that lead to irresponsible lending and financial system strain. The current U.S. credit cycle's easiness stems from the Federal Reserve's excessive money printing. In response to the 2020 COVID-19 recession, the Fed cut interest rates to their lower bound and supplied $4 trillion in liquidity. This led to reckless lending at low interest rates without suitable compensation for potential borrower default. The easy money policy ended abruptly at the beginning of last year, forcing the Fed to control inflation, which had surged to a 9% high. The Fed raised interest rates by 525 basis points within 18 months, marking the quickest pace in the post-war era. This shift from excessive market liquidity to monetary tightening had a severe impact. The new monetary policy resulted in significant damage to the banking system's large bond portfolios, causing a decline in Treasury bond prices. Silicon Valley Bank and First National Bank, two of the largest U.S. banks, failed due to this impact. The potential for another regional bank crisis is heightened by the recent spike in Treasury bond yields, caused by concerns over the government's 8% GDP budget deficit. The U.S. banking system estimated a $620 billion loss on its Treasury bond portfolio even before the recent yield jump. The fall in Treasury bond prices will only exacerbate these losses. A new round in the banking sector crisis is also anticipated due to the expected defaults on commercial real estate loans. In a post-COVID world, office occupancy rates are unusually low, raising questions about property developers' ability to roll over the $500 billion in property loans due next year at higher interest rates. This could pose a significant challenge for regional banks, as commercial real estate lending makes up to 18% of their balance sheets. The Fed's practice of maintaining high interest rates raises questions. Doubts are also raised about the wisdom of its policy of withdrawing $95 billion a month in market liquidity when the Treasury is struggling to finance itself at reasonable rates. By continuing to inflict significant losses on banks' balance sheets through higher interest rates, the Fed seems to be courting a major financial crisis before mid-next year.